The revenue recognition principle. The revenue recognition principle under GAAP dictates that revenue must be recognized when it is earned and realizable, regardless of when cash is received. Earned, the company has substantially completed its part of the transaction. Realizable, payment is reasonably assured. This principle supports the accrual basis of accounting, separating revenue recognition from cash inflow. Introduction to ASC 606. ASC 606, issued jointly by the FASB and IASB, created a comprehensive, industry-neutral revenue recognition standard. The goal is to increase comparability and transparency in financial reporting. It replaces hundreds of industry-specific guidelines with a single 5-step model applicable to all revenue-generating activities. The 5-step revenue recognition model, ASC 606. Step 1. Identify the contract with a customer. A contract is an agreement between two or more parties that creates enforceable rights and obligations. Criteria: parties approve the contract. Rights to goods/services and payment terms are identifiable. Commercial substances exist. Collection is probable. Example: a signed 12-month software subscription with defined payment terms qualifies. Step 2. Identify the performance obligations. A performance obligation is a promise to deliver a distinct good or service. A contract may contain one or multiple obligations. Performance obligations must be separately identifiable. Example: a laptop sale bundled with 2 years of tech support has 2 distinct performance obligations. Step 3. Determine the transaction price, the amount the entity expects in exchange for transferring goods/services. Includes fixed consideration, variable consideration, discounts, refunds, incentives, non-cash consideration. Consideration payable to a customer. Example: a company offers a bulk purchase discount, this must be factored into the transaction price. Step 4. Allocate the transaction price to performance obligations. Allocation is based on standalone selling prices of each obligation. Discounts and variable elements are allocated proportionately unless criteria for allocation to specific obligations are met. Example: if tech support is valued at $200 and the laptop at $800, and the total transaction price is $900, allocate accordingly. Step 5. Recognize revenue when, or as, the entity satisfies the obligation. Revenue is recognized either over time or at a point in time, depending on how the performance obligation is fulfilled. Over time, services like subscription or construction projects. Progress measured through output, milestones, or input, resources used. Point in time, delivery of a physical product. Industry applications and challenges. Software industry: multi-element contracts, licenses, updates, services. Subscription-based, revenue recognized over time. Construction: long-term contracts, percentage of completion method. Retail sales: returns, gift cards, and loyalty points must be estimated and adjusted. Telecom bundled plans, device plus service. Allocation of revenue over contract term. Revenue disclosures under ASC 606. ASC 606 requires extensive disclosures in footnotes, disaggregation of revenue, contract balances, assets/liabilities, performance obligations, significant judgments in applying the standard transaction price allocation. Common misstatements and ethical red flags. Premature revenue recognition, e.g., booking sales before delivery, channel stuffing, pushing excessive inventory to resellers, round-tripping, fake sales for reciprocal purchases, misallocating discounts across performance obligations, failure to disclose variable consideration consequences, SEC sanctions, restatements, audit failures, and shareholder lawsuits. Case study example: Groupon, 2011. Groupon recognized gross revenue from vouchers, rather than the net commission earned. The SEC required restatement of earnings, and the stock dropped 20%. Lesson: misapplying ASC 606 or ignoring proper allocation can mislead stakeholders and erode investor trust.